The minutes from the last meeting of the Federal Reserve's Open Market Committee were released today, and there's quite a bit of interesting tidbits in there. After the press conference, which we get the press conference immediately after the meeting, and we get the minutes, some weeks after this meeting was on June 16th, I believe, or right around mid-June. And Powell came out and gave the press conference, and he said to the clapping seals, who are the financial press, that we are officially talking about tapering. And the minutes would bear this out. Or tapering did come up in the meeting, and I have to say, I'm quite impressed. The big, I won't bury the lead. The big thing for me to come out of these Fed minutes was that the Fed themselves, or at least some people on the committee, are admitting that low interest rates are contributing to higher housing prices, and that poses a risk to financial stability. And therefore, they would like to taper the purchases of mortgage-backed securities first. Now, that is about the most mild acknowledgement of the housing bubble that the Fed has created in the wake of the collapse or popping of the last housing bubble that I could ever imagine. But hey, at least they're acknowledging it to somewhat of to a certain extent, because old Bernanke never even acknowledged the housing bubble after it popped. And furthermore, when it was popping, he said it was no risk to financial stability. He said subprime is contained. Now you have folks at the Fed who are saying, hey, in so many words, there is a housing bubble. We created it. And if it pops, it will not be contained. It will pose a risk to financial stability, which is exactly correct. Consumer spending in this country is heavily influenced. I don't know, obviously depends by person, but it is influenced overall by the wealth effect, meaning when the assets that people own go up in value, they feel richer, and therefore they feel more secure spending more of their income every month. In other words, if you're underwater in your house, you're probably not eating out as much as you would if you have like double the equity in your home. If you've got 200% equity, if your house is worth twice as much as the amount of money you've put into your house, you probably feel pretty wealthy. You probably feel financially secure. But if your house is only worth 70% of what you paid for it, you might be tugging at your collar a little bit and starting to feel the heat. And so that's just the risk to the consumer economy, let alone the financial economy. I'm just pointing out a very minor thing that, hey, all of this massive consumption, which we have seen, we are a nation of consumers. That's all we have left. Remember, we don't produce things in this country anymore. We consume things. We're a one-trick pony. And so that alone could be severely hampered by any drawdown or correction in the housing market. But if, as I pointed out in the past, I think that all risk assets, because of the nature of this bubble, we are in, what I and many other people call the everything bubble. There's a high correlation between the values of all asset classes, whether it be real estate, bonds, or stocks, because they're all going up for the same reason, because of Fed liquidity. That is what's pushing them higher. And so therefore, again, as the Fed points out here, there is going to be severe risk of financial instability as a result of this housing bubble that we can forecast, merely on an empirical basis. You don't even need to necessarily, because again, it's very complex, all of the financial plumbing, and we don't know. I don't know what kind of dominoes will start to fall if, for example, housing prices tank 20%. I don't know how that will affect all of these other markets, but what I do know is that just looking at the chart, and Sven Henrik in his latest video, if you go out and check out his channel, he mostly paywalls all of his videos, so I haven't seen very much from him in a long time, but he just put out a video for free on his channel, Northman Trader, and he has a chart showing a pretty convincing correlation between housing prices and the S&P 500. And so it didn't tell me anything I didn't already know, but it was interesting to see, to see him chart it out on paper. So what does this all mean? It means that folks at the Fed think that if they don't buy as many mortgage-backed securities every month as they currently are, which let me explain for you what they mean by that, if you're not familiar. Currently, the Fed is buying $40 billion a month in mortgage-backed securities, which means that they are dumping $40 billion into the mortgage market. They're purchasing mortgages from banks. And so what that does when you securitize mortgages, and you're getting them off of a bank's balance sheet and recapitalizing that bank with cash so that they can then take that cash that you paid them and go out and make more loans. It's just speeding up the process of mortgage origination. It's the Fed's way of giving a shot of monetary heroin right into the arm of the housing market every single month. They're just injecting $40 billion into the housing market every month, month on month on month. And these guys are saying, you know what, if we keep this up, we might just kill the patient. And so maybe we need to start weaning the housing market off of this, this $40 billion a month in monetary heroin. And maybe then things won't get out of control. But obviously, anyone who's looking at the housing market can see it's already gotten way out of control. I mean, it's not very hard to pull up, a long-term chart of the Case-Shiller price, home price index, and see, oh, gee, from 1998 to 2006, you see this massive bubble that forms and then pops and bottoms out in 2012. Where does it bottom out? Well, it bottoms out at the long-term 100-year average for home prices. It just reverted to the mean. Home prices were not low in 2012. They were normal. They returned to normal. That's it. And what have housing prices done since 2012? Or since 2013? No, I guess it was around 2012 or 2013. Depends on what metro you're looking at. But ever since then, they've gone straight back up and made new highs. So it's not even is it a bubble? No. You just have to look at the chart itself. It's it's physically a bubble. It's the shape of a bubble. And so the Fed has no way out of this. It's not like, maybe if we just sort of sneak out the back door, nobody will notice. Well, no, you have to keep inflating this higher and higher. Once you've created a bubble like this, you have to keep pumping in more air, or else the air will come out of the bubble. So either tapering the purchases of mortgage-backed securities, they go from 40 billion down to 30 billion, down to 20 billion, down to 10 billion, down to zero, that either is going to have very little effect and not too much to affect the housing market, and thus the housing market will still be a risk to financial stability, or the tapering will be enough to send mortgage rates sufficiently higher to where housing prices stop rising at such a high rate, or perhaps even start to fall a little bit. In which case, the Fed may very well prick the housing bubble. In which case, again, financial stability will be put at great risk, because then the housing bubble will have popped. And so whatever risk to financial stability you were worried about is going to come to pass. So while I'm glad that there are some people who are raising concerns about this inside of the Fed, I have no idea what they're thinking, because if the Fed does, what they want, which, I think is the right thing to do, there's going to be pain felt for that. So again, just to go over the mechanics of what's going on here, the Fed, by injecting billions and billions of dollars into the mortgage market every month, is pushing mortgage rates lower because there's more funds available to loan out to people. And so people are able to borrow more than they otherwise would, because when people are buying a house, they only care about what's my monthly payment going to be. They don't care about what the principal they're paying is on the house. They look at, okay, I can afford to pay $2,000 a month. And so when mortgage rates are at 5% and you're paying $2,000 a month, buys you a much lower priced house than $2,000 a month at 2.5% annual interest is going to buy you. And so it's very simple math. Mortgage rates come down, housing prices go up. Mortgage rates go up as a result of the Fed tapering their purchases of mortgage-backed securities. Well, then housing prices go down. Make no mistake, that will have ripple effects, not just in consumption. There will be throughout the financial system, because, just like last time, I'm sure people, the banks probably are wary of mortgage-backed securities after last time. So they're probably, there's probably not nearly as much risk as there was back then. But then again, you have a lot of private equity firms and other Wall Street agents investing in the housing market because they are chasing that yield, that high single-digit yield, not even a double-digit yield anymore. You can't make 10%. You can't make double-digit returns on rental properties these days. But they're chasing that high single-digit yield, and who knows where their stops are. At what point, are they buy and hold guys? Or I would think at some point they get stopped out and they say, you know what, housing prices are falling too much. We're going to sell out of our prices. And, who knows what percentage of the housing market in certain areas is now owned by institutional investors. And there's tons of little things. You never know, because of the nature of markets, which are supposed to be complex systems that central planners are not capable of fully comprehending and manipulating. You end up with any multitude of different scenarios and problems that will arise once the tide is pulled back, and we see what fundamental value there is without that central bank intervention. But don't get too excited. The Fed is a very cautious beast. It doesn't like to do anything without giving Wall Street really an obscene amount of notice and forewarning. And so we're not going to be seeing them tapering mortgage-backed securities next month or anytime soon. They will, start to let people know and start floating more trial balloons if they're really considering that. And they will say for sure, hey, we're going to start tapering. And again, tapering doesn't mean we're not going to buy any. That just means we're going to buy less. We're going to be decreasing the dosage on our monetary heroin just in the mortgage market over some period of time, which, at the beginning of which has not even been considered, let alone announced. But hey, this is the Fed's first mention of it. We'll see how they keep talking about it in the future, but at least this is a sign that they have some interest in popping the housing bubble at some point. Now, one last thing I want to mention was Zoltan Posar put out a new note, and he is setting a target for August of this year for the reserve repo to hit around $2 trillion, which he did that based off looking at a bunch of money market funds and seeing how much money they have in T-bills yielding less than 5 basis points, because the reserve repo rate is now 5 basis points. And so if you have, there's no real point in owning any assets that yield below 5 basis points if you can get that from the Fed, and the Fed can print money. So if you're if you're lending money to the Fed, they're always going to pay it back. And that seems to be the reason why there has been a surge into reverse repos ever since the Fed raised the reserve repo rate from 0 to 5 basis points. And again, that's 5% of 1%. It's 1/20th of 1%. And in practice, in my opinion, it's a form of quantitative tightening. This whole reverse repo operation, which by the way was mentioned in the Fed minutes. The Fed seems it seems like something that could have happened pretty quickly. They're going to make the reserve repo facility, which is considered temporary, permanent. And so reverse repos are going to be a part of our reality for the foreseeable future, which is not surprising at all. They seem to be pretty darn integral at this point, since we're going to hit probably over $1 trillion in reverse repos here in the next few weeks. But anyway, Zoltan did some, back of the envelope math. Each counterparty who participates in the Fed's reverse repo operations is allowed to have 80 billion essentially. And so he looked at a bunch of money market funds and said, okay, well, how much of that 80 billion are they already investing with the Fed? And how much of that 80 billion limit, do they have to expand upon? And how much do they have in T-bills that are yielding less than 5 basis points? And so he added that up for a bunch of money market funds, and to him, it seems like there's room for reverse repos to hit 2 trillion by about August. And so what does that mean? Well, like I said a minute ago, and as I said a couple weeks ago, to me, and again, I'm a layman, I'm not a banker, just looks like quantitative tightening. It looks like the opposite of quantitative easing, because what the Fed does when they do quantitative easing is they go to banks and they buy bonds off of their balance sheet, and they replace that with reserves, held at the Fed. And so, what we would call cash, although, that's somewhat disputed whether it's appropriate to call that cash or not, but I'm going to call it cash. And reverse repo is when banks or other financial institutions come to the Fed, give the Fed cash, and the Fed allows them to borrow bonds. So the Fed is essentially, through reverse repo, taking back the cash that they're injecting into the system through quantitative easing, and putting the bonds that they took out of the system through quantitative easing back into the market. So it is a reversal of quantitative easing. And so if I'm looking at this market and I'm saying, gee, seems like everything's being held together with duct tape and QE, and I see what is effectively QE shoot from close to zero up to, or QT, shoot from close to zero up to 700 and some billion. Spiked for a day to almost $1 trillion, but that was a quarter-end rebalancing. But now, again, Zoltan's saying on track for 2 trillion, near 2 trillion by August. Well, I look at that as $2 trillion in quantitative tightening. That's got to have some effect, right? I mean, if quantitative easing has had any effect on inflating this asset bubble, $2 trillion in quantitative tightening should have an effect as well, I would think. So I'm in wait-and-see mode as far as that's concerned. I don't necessarily understand why nothing's happened yet or why something will happen later. But again, this is just, I'm trying to make sense of all this stuff. And, we're so far in uncharted waters, financially speaking. I don't feel too bad that I don't know what's going on. There's a lot of people who are a lot smarter than me who don't necessarily know what's going on either. So that's those are the two big financial updates for the day. So I will see you folks back here tomorrow.